Hey everyone, welcome back to Corporate Decoder. Apple Incorporated just filed an 8K report, and their plan to redeem debt with stock is raising some eyebrows. Quick note, this is not financial advice, just my take on public filings for educational purposes. Virgin Galactic is trying to get ahead of its debt payments, but the way they plan to do it might offer a clue about their financial situation. So here we are looking at a report from the 2nd of June 2026. Virgin Galactic Holdings Incorporated, or SPCE as you know it on the stock market, is filing an 8K report. This is a current report, meaning something important just happened that the company needs to tell investors right away. This form, the 8K, is like the company's way of calling an emergency town hall with its shareholders. They have to report big events, and today's event is all about managing their debt. Virgin Galactic, the company that wants to take you to space, is facing a significant financial move. They need to deal with some debt that is coming due, and the way they're planning to do it could impact the stock. Their common stock, which trades under the ticker SPCE, is what they'll be using to pay off some of this debt. This is a pretty common practice, but it is how it is being executed that matters. The main story here is under other events. What Virgin Galactic is doing is trying to get ahead of its financial obligations. They're preparing for commercial operations later this year and want to make sure their finances are in order. So they have these things called first lien notes, which are basically loans. A big chunk of these loans, over $30 million, is supposed to be paid back by September of 2026. They've already paid back some $10 million. But there is still over $20 million left in what they call a mandatory redemption amount. On top of that, there is another payment over $10 million that is due by the end of 2027. If Virgin Galactic successfully redeems all of this debt that is due between now and the end of 2027, then they won't have any more principal payments due on these specific notes until March of 2028. That is a significant chunk of debt. They're trying to clear off their books before it is strictly required. So on the 2nd of June 2026, they officially announced their intention to redeem this debt. This notice, the notice of redemption, is their formal communication to the lenders. They plan to redeem as much as about $30.5 million worth of these notes on the 10th of June 2026. The price they'll pay is called par, which means the face value of the debt plus any interest that is already built up but hasn't been paid. Now here is the crucial part for investors. How are they paying for this? They are not paying with cash. Instead, they are issuing shares of their common stock to the people who hold these loans. This is called debt for equity swap. It means the debt holders will become shareholders. The exact number of shares they'll issue depends on something called the volume weighted average price, or VWAP, of their stock over a 5-day period. The VWAP is basically the average price of a stock over a given time, weighted by the volume of trades at each price. It is meant to give a more accurate picture of the stock's trading range than a simple daily average. However, there is a catch. If the stock price drops too low during this 5-day observation period below a certain floor price that is written in the loan agreement, Virgin Galactic has the option to not redeem all of the debt. This means the actual amount of debt they end up redeeming could be less than the maximum they've announced. This is important because it directly affects how much of this debt is retired and how many new shares flood the market. If the stock price is weak, they might not be able to execute the full redemption. The company says this is all part of their plan to manage their money and make sure they have enough flexibility. They believe now is a good time to do this because of market conditions. By paying off this debt early, or at least dealing with it early, they expect to reduce the amount of cash they have to spend on interest payments going forward. They are essentially trying to save money on interest by handling this debt now. Plus, they see this as a strategic move that aligns with their upcoming increase in space flights. Now, like any company filing, they always include these forward-looking statements. They're basically saying, hey, what we're saying now is based on what we think will happen, but things could change. They're talking about the potential redemption of these notes and their expected increase in spaceflight frequency and pricing. They point you to their other filings like the 10K for a full download of all the risks they face. It is like saying, go read the whole rulebook if you want all the details on what could go wrong. And they make it clear, if any of those risks actually happen, the actual results could be very different from what they are predicting today. They are urging people not to put too much faith in these predictions because these statements are only good as of the date of the report, and they're not promising to update them unless the law requires them to. And then we have the signatures. Douglas Aarons, the Chief Financial Officer and Treasurer, has signed off on this report. This is the person responsible for making sure the financial reporting is accurate and that these important filings are made. So what does this all mean for Virgin Galactic? They're taking proactive steps to manage their debt. However, using stock to pay off debt can be a double-edged sword. On one hand, it preserves cash. On the other hand, it can dilute existing shareholders. If the stock price is struggling, as we've seen some recent headlines suggesting, It implies that the market might not be too thrilled about a potential increase in the number of shares outstanding soon. This move, while strategic for debt management, introduces immediate pressure on the stock price from the potential issuance of new shares. It is a classic balancing act between alleviating immediate financial pressure and potentially impacting shareholder value in the short term. The key here is that the success of this debt redemption hinges on their stock price holding steady or increasing during that observation period. If it dips too much, they might not be able to execute the full plan. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. Like, comment, subscribe, and join our Discord for more insights.